everyone. Thank you for joining our educational webinar surrounding FinCEN's proposed rule to strengthen and modernize financial institutions, AML CFT programs, risk assessment process. We're going to begin in a few minutes, giving everyone a chance to get in as we have over 250 registrations today. So just sit tight for a couple minutes and I'll be with you shortly. Thanks. Okay, I think we're ready to begin. A couple things before we begin. I wanted to just mention that there is a box at the bottom of this page, at the bottom of your Zoom, says interpretation. You can click there and switch from English to Spanish. We'll have a Spanish translation for you if you so wish. Also wanted to point out the chat box to the right. Please feel free to answer questions, ask questions. We'll have a Q&A session at the very end of the presentation. So please enter them. We'll get to as many as we can. And if not, we'll have a link for you to ask them directly to us after the webinar. Introduce myself. My name is Jose Lamas. I'll be your moderator this morning. I've been with RiskRadar for just over 3 years now, after being on a trading desk for 10 years. So in other words, I used to be terrified of compliance, and now I am very much not terrified of compliance. So really happy to be here, and thank you again all for joining us. Some topics we'll talk about today include identifying best practices and processes, data gathering, and how to identify and evaluate different AML risks, among other key components to a sound risk assessment. We are fortunate enough today to have Ana Maria de Alba as our guest speaker. Ana Maria is a risk management and banking consultant with over 30 years combined experience in the banking and consulting services industries. She's the founder and CEO of CSMB International, a US-based risk management practice, and a co-founder and the Chief Product Strategy Officer of RiskRadar, an AML CFT entity-wide risk assessment software. Ana Maria specializes in issues related to the financial services industry in connection with risk management, assessment and evaluation of internal controls, regulatory compliance, correspondent banking, and in financial investigations stemming from allegations of fraud or money laundering in the US, Latin America, and the Caribbean. Really lucky to have her. Thank you so much, Ana Maria, for joining us. Everyone, it's my pleasure to hand the baton over to Ana Maria de Alba.
Thank you so much, Jose, and thank you all for showing up today. I see that we've already have, of the 250, about close to 100 have already signed in, and you can continue to, looking at the participants, and I see that they continue to log in. So we are going to go ahead because we do have a limited amount of time and everybody's got to go back to work. So the good thing is that we will be sharing this presentation with anyone that signed up. So whether you came in late or came in on time, you will be getting a copy of this presentation. And it's also being recorded, so we will be able to also share with you that recording. So let's get to business here. Let me open up the presentation that I have for you today. So I guess everybody's able to see my screen. Perfect.
Yes.
Wonderful. Thank you. So yes, one of the things, and I know that a lot of you have already started to look at this this topic. It was in the middle of, at the end of June. We all woke up to a nice advisory or notice from FinCEN, which was a proposed rule to strengthen and modernize the financial institutions' AML CFT programs. One of the things that they talked about a lot was changing from BSA AML OFAC, which is what we always referred to in the United States, to our AML programs. The word is we should start changing to the more standardized international name, which is the AML CFT. We've been working with that sort of name for many years with the foreign countries, but yet in the United States, we still called it BSA AML, which confused a lot of foreign institutions. Luckily, we've already gone over that. And in the United States, we'll also be calling it that. But that was not obviously the gist of this advisory. It was more to begin emphasizing on some of the new regulations under the AML Act of 2020. So this is proposed rules. And what we intend to do today is to help you navigate through one of them, which is the risk assessment process. And again, this is not the rule has not been issued in its final form yet. A lot of letters have gone out to Washington, including from our Bankers Association, or ex-Bankers Association, because it's now in Institutions and Business Association, which is FIBA, wrote a letter exposing some of the ideas and different objections that they have with some of the requirements of the new law. So basically, the proposed rule would require a financial institution's AML, CFT, or BSA AML program to include a risk assessment process to better enable it to identify and understand what their exposure is to money laundering and terrorism financing and any other type of illicit finance activity, including the famous national priorities, which are all related to illicit financial activity or illicit activity that generates illicit financial gains. Okay, so basically, that was the beginning of this notice, and even though this is not new to the United States, we have been adding that risk assessment process to our AML programs since back in 2001, when the USA Patriot Act came into effect. That's been an expectation, but it wasn't codified into law. So under the proposed rule, financial institutions would be expected to use the results of the risk assessment process to develop the risk-based internal policies, procedures, and controls to manage and mitigate the risks and provide highly useful information. This is key in the proposed rule. Highly useful information to government authorities, as well as to further the purposes of the BSA, which is to deter, detect, and report suspicious activity. But this wording is very peculiar, and it's so broad that it has caused for a lot of comments being sent back to FinCEN from various groups around the United States, asking how are you going to measure? Because one thing is what they say, and another thing is how it gets regulated and supervised after the law comes into effect. So using words as highly useful information, what does that mean? And so also the use of an assessment process. What does that mean? What are going to be the expectations? So the proposed rule would put into regulation what is existing, the risk practices that we currently have in place, and adds to it a twist: innovation and the adoption of technology to that assessment expectation. Okay, so it's not just what we have been doing up until now. As you all know, you are bankers. You are exposed to at least the financial services industry, if you're not particularly just a banker, but within the community, right? One of the most important things is that within the last even 5 years, the financial services industry has changed dramatically in the way that consumers deal with their financial institutions, the products that are offered, the services that are offered, how the consumer accesses those products and services, and a host of new things in terms of technology that allow for cross-border payments, et cetera, et cetera. So there's been a lot of changes. So allowing for those changes to really form part, not allowing, but being able to monitor and risk rate those new ways in which consumers access banking services and institutions provide their banking services is going to require a lot more than an Excel spreadsheet. That is the expectation. So Again, it's not a regulatory requirement, but it is part of the AML Act. And one of the things I remember FinCEN saying is it is time for, and it's written in the AML Act, that financial institutions should embrace technology. Why? Because a lot of the new ways in which products are offered, even in the way that we're onboarding clients, includes new methods that were not known before. So the same ways in which we were addressing some of the risks that were related to, say, the onboarding of a client, now we have different processes, we have different risks, and therefore different policies and procedures to address those risks. So technology is going to be a lot more helpful in this case, now that these new technologies are in place to onboard clients, to provide services, et cetera, et cetera. So in just focusing on the risk assessment process, what I wanted to talk to you all about today is what is the sound risk assessment process, and that generally includes 8 steps. We always look at the risk assessment, the risk assessment analysis itself as having 2 steps, which is identification and the assessment itself. But the process includes 8 steps, and this is establishing the framework, gathering of information. This is extremely important. This is a process that can be top down or bottom up. Identification of risks, obviously, not just the risk factors, which are the 5 that we all know, which is clients, products, services, channels of distribution, and geographies, but the risks that are associated to each one of those risk factors. Also, the process of evaluation of those risks and establishing the risk mitigation control measures that are in place. How adequate and effective are those to mitigate those risks that have been identified? Then comes the process of documenting the assessment and communicating that assessment to all the stakeholders. That is a crucial part of the risk assessment process. Also very important, the review and update of that process on a continuous or an ongoing basis to make sure that every time you do it or periodically, you know that the system is working properly. And finally, monitor and audit. Okay, so we're going to go over each and one of these. In the first case, we're going to talk about the establishing of the RAS, or the risk assessment framework. We colloquially call it RAS here in our at the company. But I think we had a question here. If you could see the screen clearly. Okay, perfect. Sorry about that. I just saw a question and I wanted to make sure that we were answering it. So the first step, oops, sorry, let's go back to 1. Sorry about that. Let's go back to that. So the first step in the risk assessment process is to establish the framework, which is going to include defining the scope of the assessment. And the scope of the assessment is what is it that we're going to analyze, and even the period of the assessment. Is it going to be a 3-month period? Is it going to be a whole year? Is it going to be 18 months? Is it going to be comparing to a prior period, similar period? And all of that it's got to be established so that you understand what, or the board of directors who is going to be receiving this information understands what is it that we are looking at, okay? What is the objective of the assessment is going to be, is you have to establish that as the process by which you're going to identify which are the greatest risks to which your organization is exposed to, so that the proper resources are directed to mitigating those risks. And the way to do it is through a risk assessment. So that's going to highlight where you have the biggest gaps, or even if you don't have a control gap, because you may be applying a strong control, if the inherent risk is very high to begin with, you may not be able to reduce it through internal controls to a very low residual risk. So that is going to be a determination that your board of directors is going to have to make once they review the results and determine whether they want to accept that risk, that level of risk, if it's within their tolerance or not. And then the decision has to be made as to what are you going to do? You have it, you're offering the product, or you're catering to that type of client. What are you going to do? Are you going to transfer that risk? Or are you going to eliminate? Eliminating would mean getting rid of or exiting a complete type of client type or a complete a type of product or service. And it recently came out also via a FinCEN advisory that it is very important that everything that you reject, you have to have had a process of risk assessment to determine why you are rejecting. So in other words, in terms of, and this is also part of the AML Act with regards to financial inclusion, right? And not exiting types of businesses or types of clients just because there's a perceived risk about it. You must demonstrate that you did a risk assessment and that risk assessment gave you a result that is too much risk for you or your organization to accept, and therefore you are rejecting it. You are getting rid of it. You are exiting that. So you're going to need to demonstrate that to your regulator. And also very important is that in that first step, you have to establish and define what the methodology of the assessment is. And this is where a lot of entities run into trouble. Because when they are putting together the risk assessment, they kind of forget, on one end, to document how that methodology was created, and on the other end, sometimes we've seen that they're mixing methods, mixing the calculation process, or even getting it wrong for that matter. So these are very important things that you need to keep in mind when you are establishing that framework. The framework must also include methods by which to ensure that the assessment complies with relevant laws and regulations. And that's what I said earlier. So that assessment needs to be able to identify, for instance, the SARs that are being filed on a yearly basis. What is the result of those SARs? Are we taking that into consideration in our risk assessment? What are we filing on? And do we have proper controls now in place to further deter that type of activity in our organization? Also, with regards to laws and regulations, you'd have to see whether you are exiting a type of client or a type of product or service just because it's too much without having done the risk assessment. So again, you have to make sure that your process addresses all of these things. The second component, which is information gathering, is a key component of the risk assessment process because it collects all the data. And this is where, and I am going to do a little plug in here with RiskRater, is because RiskRater, as you should, it doesn't have to be automated. Automated makes it better, but you should be doing this. You have to collect data. We use data collectors. We use data collectors to be able to quantify the amount of risk to which the organization is exposed. And we quantify that by basically doing a full calculation of the entire inflow and outflow funds. You should be doing that whether you have an automated system or even if you're doing it through Excel spreadsheets. It doesn't matter how you do it. You need to quantify that to be able to define properly what your inherent risk is. So like I said, RiskRater utilizes the data collectors process as the key element for risk quantification within the process to identify inherent risk. You should be doing that on your own, gathering information, which is calling the IT department or the loan department or the business the head of business to find out, can you give me these numbers? Can you give me how much are we going to bring in new business next year? Or how much was the new business that we brought in last year in correspondent banking, in private banking, in consumer lending? Whatever those numbers that you are collecting, the source of that could be erroneous. It could have not, maybe you're not party or part of that calculation. So it is better to do it through a data collection process where automatically from your core banking system or from your transactional monitoring system, you can collect all this data and quantify the flow percentage-wise of the money that comes in and that goes out of your organization to be able to identify where there's greater risk in each of your areas of risk. So the next step is to collect data and transaction on clients, products, services, channels of distribution, and geographic locations, and compare that data to prior assessment to define direction of risk. So by collecting this, we are saying, okay, when we're analyzing the say customer base, we will be able to say, last assessment we had 2,000 clients. That was our entire client base. We had 2,000 clients. This assessment, we have 2,500 clients. So that means that we've increased by 500. What does that mean? It's a percentage of increase of increment in the number of clients, but how does that impact our risk? Is it through, are these new clients utilizing high risk products or low risk products, or what is it? So you need to be able to say, if those new 500 clients that we have are all using our higher risk products, that means that our direction of risk is increasing. That's just an example. But again, this is part of the information gathering process. The third step is identifying risks, okay? And in identifying risks, the process should include an assessment of the potential risks associated with client types such as individual, business, domestic, whether they're domestic, whether they're foreigners. So we start now segmenting data. And this is a very important process of the step of identifying risk, the segmentation of all of your activity and all of your clients that have to be separated by, whether it's an individual, whether it's a business, what type of business. Is it a shell company? Are these shell companies? Are these operating companies? Are these foreign companies? Are these individuals that are foreign, et cetera, et cetera. Also looking at specific sectors, which are like the professional service providers or the PSPs, the personal investment companies, or PICs, how we call them here in the US. These are shell companies or paper companies. Also MSBs, which are the non-banking financial institutions, et cetera, et cetera. And also jurisdictions, both domestic and foreign. When we talk about jurisdictions, that process of identifying risk, we want to see not only where our clients are from, but also where the money is coming from and going to. So one of the things that the AML Act talks about in terms of terrorism financing, for instance, is about domestic terrorism. So one of the things that we're pushing a lot for, and you should start looking at that within your organization, because this could be an expectation from your regulators soon to come, is how are we identifying within our own region, say in the United States, how we are identifying where our transactions are going to and coming from within the United States. Are these going to or coming from HIVCA, HITA areas? To know that, you would need to have a proper knowledge of the zip codes, for instance, of all of the transactions that come and go. That way, you will be able to know, based on the information that's been provided by through the HIVCA, HITA lists, where if a majority of your transactions that are flowing through your organization are coming or going to specific zip codes, that may represent a higher risk area. So you're not only expected or required for by now to know if you are transacting or your customers are transacting with foreign jurisdictions that may be considered higher risk, and they've been classified either by you or by supranationals, like could be the AML, Basel AML index, which a lot of financial institutions use as their base for defining jurisdictional risk. This is an important assessment that you also need to do. And for those of you that are participating here today or listening to me today that are from, say, Miami-Dade County, we can always, lift our arms and say, oh, well, we're in a HIVCA jurisdiction, so we cannot say that all our transactions are high-risk transactions, and that's very true. But we are starting from a premise that we are already in a high-risk jurisdiction. So we also want to know we have controls and we understand our area. So that could reduce, because of the level of understanding that we have, that could reduce our perceived level of risk. But what about the other HIVCA areas that you're not analyzing? So it is important because part of the AML Act talks about specifically, basically the national priorities talk specifically about domestic terrorism. And we are going to be seeing a lot more scrutiny directly from regulators when they come and review your risk assessment. They're going to ask you, how are you applying controls to detect potential activity that is related to domestic terrorism? Because that's one of the national priorities. And this would be one of the first steps that you could say, here's how I do it. We have segmented a process within our risk assessment process that allows us to know the amount of activity that takes place in all the HIVCA areas within the United States. And the only way to do that is by keeping track of all of the activity through zip codes. So that's a tip for you all to begin adapting some of your transactional monitoring systems to capture that information within especially the wire transfers that you're doing. Another part of the identification of risk is identifying vulnerabilities in products and services, such as the cash-intensive businesses or online access to services. And one of the things is when we look at product, services, et cetera, we always hear that inherent risk should only be calculated based on your level of activity and your unique offering at your institution. And to say that, for instance, a PSP automatically is a high risk type of customer, or an MSB for that matter, it's not the expectation of the risk assessment process. The expectation is that you do risk assess that type of customer to determine whether their activity really exposes your organization to a higher level of risk. What I say about vulnerability is that you need to take into consideration from the get-go that this is this class of client is vulnerable because they can use specific types of accounts within your organization to transact activity that doesn't belong to them, that belongs to their client, a third party that is unknown to you. That's what makes that class of client a little bit more riskier than others. But depending on how much activity they have will reflect on the amount of risk that you're exposed to. But that's why when I say vulnerabilities, a lot of products all have inherent vulnerabilities, but they're not necessarily inherently high risk. Inherently high risk will be determined within your organization based on the actual activity that flows through your organization through that product or that service. Okay? So the fourth step, which is evaluating the risk, this is where we get to the part where the evaluation is part of the analysis of the probability and the impact of identified risks in order to define the true inherent risk of specific risk events versus the perceived inherent risk, which is what I just said. The perceived inherent risk is really a vulnerability of that product or that service or that class of clients. But the inherent risk, you have to calculate it. And the probability is defined by the quantity of risk, which is derived from the volume and count of transactions. And you're going to look at historical data, meaning that what has your institution transacted over a period of time, whether it's, like I said, 3 months, 6 months, 9 months, whatever your assessment period or scope of assessment is. Then you also have to look at the impact. The impact of a risk event materializing is then analyzed based on its legal repercussions, the risk of the operations, your operational risk, and risk of reputation. So taking those 3 specific risks into account, you're going to determine if that's a high impact, if this materializes, if this risk event materializes, and you'll know if there's a high probability of that risk event materializing, multiplied by a high impact, you're going to have a specific defined risk, inherent risk value or inherent risk classification. So that's how you really arrive to that inherent risk in a proper way. You also have to create or use a risk matrix, as we all know, to categorize this risk. And the risk matrix that most of us are using are either Excel-based, SQL, something created in-house. Some others are using there's some I think it's the ACAMS that has a platform out there. But the difference specifically with that one particular tool is that it doesn't take into account transactional activity. This process, it doesn't take this process of quantification into account. It's what we call a top-down. Top-down meaning you gather information, whatever information is given to you, you plug it in, and it gives you something. The proper way and the way that the regulators, and actually what FinCEN told us when we first introduced RiskRadar to FinCEN during innovation hours, was that you need to quantify it. You cannot just ask IT how many, what was the volume of activity in and out through DDA last year, and they give you a number, and you just rely on that number and plug it into your Excel spreadsheet, and boom, there you have some sort of calculation. That is a top-down because it's based on questions that and answers that you're receiving. Quantifying it is a top-down approach, which is the expected process that you're going to be supervised on moving forward. So the fifth step is establishing the risk mitigation controls. And there we analyze and qualify risk mitigation controls. That's where we look at and test and kick the tires of the controls that you have in place. So what controls have been developed to meet regulatory requirements, your own organization's risk appetite or risk tolerance. So that has to be analyzed to make sure that it meets all of these criteria. You also want to know, are controls adopted to mitigate specific money laundering, terrorism, financing typologies? And this is where I also wanted to make a point where a lot of, we've seen this in doing risk assessments over so many years. A lot of financial institutions look at the entire list of methodology typologies and use those typologies as their risk events. And that is not the right way to go about it. The typology is a result of the vulnerability that a particular class of client, a product, service has, okay? So if they're vulnerable, they could be used to do X, Y, Z, and those are the typologies. So the risk events are really the vulnerabilities. And when you're looking at your mitigation controls, there you do have to look at whether your controls match up to these typologies. And then you have a combined process that allows you to define your inherent and your residual risk. Another part of the establishing the risk of mitigation controls, our controls, are these adequate to meet customer due diligence, enhanced due diligence, transaction monitoring for suspicious activity, employee training, and other measures that you use to mitigate risk. So are these adequate? And how do you define if these are adequate? But first of all, you have to remember that a risk assessment is not an audit. And because a risk assessment is not an audit, therefore, you're not going to do heavy duty testing. Although we have learned that some regulators are asking, how do you know that this particular control is adequate if I've not seen in your process that you've done testing? And the answer to that is we rely on the audit that was done. That's why it's important that an audit of your, or independent review of your compliance program, is done periodically and in tandem with your risk assessment. Because the risk assessment is going to look at what has your regulator said. Have they criticized any of my internal controls or my program as a whole? What does my auditor say, internal and external? And the auto evaluations or testing, periodic testing that the compliance department does on an ongoing basis. What is all of this telling me? And if all is robust, then I can say I have a robust control. But if you don't have that, or if there are pieces of things that are not being fully deployed or implemented, then you cannot qualify that control as a strong control, okay, or robust control. So this is a very peculiar and detailed process, which may include you having to do some type of testing if no one else has done it before. It's better to test, even if it's light testing, to determine whether a control is adequate, at a minimum adequate, than to say, well, because the regulator hasn't looked at it, because the auditors have not looked at it, because we have not internally looked at it, we're going to say that this control is low risk, moderate risk, high risk. That should not be your go-to process. At that point, you should embark on doing some, if anything, some light testing to make sure that you do have a process in place that you can qualify. And another thing is that if in fact you look at, in this step, you're looking at audit reports or examination reports that criticized that particular control, what has been done after that criticism, so that you can say, well, yes, it was criticized, but we have fixed it, we have remediated, and even though it has not yet been audited again, you can give it up a notch, because you say, at least we're doing something now. So those are tips that I can give you while you're doing that process of analysis of the mitigation controls. And then also at the end of all of this stuff, process, you will determine the effectiveness of controls by way of reviewing, again, past audits, reports, examinations. System validations is another way of determining whether your suspicious activity reporting process, which is a regulatory mandate, is being addressed correctly and is a strong control, a moderate or low impact control. So the other thing is the sixth step is documenting the assessment and communicating findings. Okay, this is also very important. And this is basically what regulators usually ask. The first thing, also auditors, let me see your risk assessment. By giving them a matrix, that's not enough. You need to put this down into writing. They need to understand it. They need to read. What is it that you do? What did you do? What did you do to come up to this result? What was your methodology? What was your scope? What was the objective that you tried to achieve by doing this process? You have to add to the report any findings related to deficiencies in controls that were identified, specific information concerning the organization, such as, you have any regulatory sanctions, you're under an enforcement action, anything that's related to the regulatory framework also of the organization, that all of that puts in context what the reader of that report is going to be understanding about your organization, the reasons for defining the inherent risk in the way that you did and defining the residual risk in the way that you did. All of that has to be documented. The risk rating results that you have, the risk direction, are you going to continue increasing risk, and what are you going to do to mitigate that or to control that in a way, and any recommendations. Okay, so at the end of the assessment, there could be recommendations for remediating certain things. Could be even operational things. Coding is incorrect. We did not process something correctly because we don't have the proper information classified within the core banking system. One of the things that I can tell you is that a lot of the risk assessments suffer because the data that is entered into the core banking system, even though it's regularly good, is sometimes at best just okay. Why? Because it's missing a lot of codes to be able to do proper segmentation. So things get lumped in, and it's very difficult to separate and be able to determine, if for segmentation or processes to be able to identify specific risk areas. The other thing that I want to share is that very important, who are you going to share this report with? You have to share it with all relevant stakeholders, and that's particularly with your board of directors, because based on the results of that risk assessment is that your board is going to adopt the AML compliance program, the AML CFT compliance program. You're going to ratify, they're going to ratify that program based on the result of that risk assessment. And also to your compliance staff, they need to know what to do, where to, go stronger, go lighter. To the staff, to the general staff, what do they need to do? These are our areas of risk. So when you are processing this type of account or this type of client, whatever it is that you do, these are the things that you need to bear in mind, keep in mind, because these are the controls that we need to apply. Okay, maybe there's things that require actions, maybe there are things that you require to eliminate. So it's very important. That doesn't mean that the entire risk assessment is going to be socialized with all the bank staff. It's going to be with select people. It's going to be with your compliance committee. It's going to be with your board. It's going to be with your audit committee. All of these are stakeholders that need to understand what the results of the risk assessment is. And in each of those committees, you're going to have heads of different areas within the organization. And it is their responsibility to bring that message down to their staff. And that's how they learn about the results of the risk assessment. Seventh step is the review and update. That's an important key element of a sound risk assessment. And periodically, you should review and update to ensure that changes in the business environment that have taken place are adequately reflected in any new assessment. You have to consider new and emerging risks that we may have. Like, for instance, when the 8 national priorities were first published in 2021, we first learned that for our country, domestic terrorism was something that we need to be concerned about. So we need to make sure that our process is taking that into account. Within the residual risk evaluation, you're going to make sure that you have proper controls to identify that type of activity, and therefore you will qualify the level of quality of the controls that you have. You have to consider new or any changes to existing regulations, and you have to conduct periodic assessments to ensure the ongoing effectiveness. And one of the things that the regulators have asked is forget about doing it on an annual basis, as we had been doing it since 2001. okay? Which every financial institution more or less was doing it on an annual basis or every 18 months, those who were serious about it, and others did it once and then didn't do it again for 3 or 4 years. That's changed. Definitely the regulator is going to come and ask you, and they are going to ask you, how are you innovating in this process? Are you applying any new technology? What are you doing to address some of the ways by which you are offering your products and services to your customers? Those periodic assessments, every time there's a new product, every time there's a new way by which you offer your products and services to your clients, has to be analyzed, has to be risk assessed. So forget about just doing it once a year, which, by the way, every time you do it once a year, your board of directors doesn't even see it until probably the end of the following year. So they're looking at old, stale data. So it is best to be able to conduct this, even though you're not writing an assessment, which is really what takes the most time. Even though you're not writing an assessment on it, documenting it in writing, you need to run the data and you need to see what are the changes. I'm seeing that we opened this year alone, we opened 4 new branches, or we are now expanding to a new territory. We are now in a different state. And we opened, we bought a small bank there with 5 branches. How are you incorporating that? Are you going to wait until the year is up to do your risk assessment and see what happened? You need to first analyze that, the risk that's going to expose your organization, and prepare for new controls that will apply to that new territory that you're coming in. So those are important things that you have to bear in mind, and doing a more periodic and more a continuous risk assessment is what is expected now, and what the regulator will be asking to see. How are you addressing that? How are you going to adopt that new regulatory requirement? And the last step is to monitor and audit. So continuously monitoring transactions and emerging risks to identify behavioral patterns and suspicious activity typologies is key to be able to see what controls you have in place. So you have to do that to be able to determine the controls that you have or that you need to mitigate those emerging risks and those new activity typologies, and then assess that within your assessment process. You have to conduct self-assessments and independent reviews or audits, as I said earlier, of the effectiveness of the mitigation controls. And you have to communicate results to staff, to management, and create remediation action plans or propose new mitigation measures. So this is all, I know that for many of you, this is what we've been doing this, but it's the how you've been doing this that is going to change. And what is going to change is the regulatory expectation, because embedded in the AML Act, we've seen that the regulators are looking for modernization. So they have to modernize, and they expect you to do so too. They expect that because you're using new methods of payment, methods of onboarding, that you also have new methods of really quantifying your risk and be able to do a proper risk assessment that generally is expected to be done from an not from a top down, but from a bottom up and top down approach, so that they feel comfortable that you have looked at everything that is required to identify risk and mitigate risk. With that, I wrap it up for today. I'll open up for any questions that anyone should have. And I pass it on to Jose. And if you guys have any questions, you could always write to me or Jose or anyone in the RiskRater family. Thank you so much for your attention, and I look forward to your questions.
Thank you, Maria, so much. Really appreciate that. Sure, a lot of our participants got a lot out of that. If anybody has any questions, you can go into the Q&A at the bottom. I believe, yeah, the Q&A with the question mark. And And please leave us a couple of questions. We have about 8 minutes left in the presentation. And Maria, I did have one question for you. It was on slide 2. If you want to pull up your
Oh, okay. Let me do
presentation
that
up
again.
again.
Yeah, let me do that again. Hold on a second. Okay. Share, and let me go back to slide 2. There we go. Oops, sorry. Oh, so that was an early on. Okay. Go
We
ahead.
have a question from somebody while you get there. The effectiveness of risk assessment is data. Does Risk Radar connect to a core system via an API?
Okay, no. We don't have an API. We have something that is a little bit different, but it's as secure, or I would say more secure, which is an SFTP. And because because this is a web-based solution, to do a direct connection or mapping direct, like you would with a transaction monitoring system, to do a direct connection to the core banking system may be too ambitious. A lot of what we do is create queries that are easily done by either your IT department extracting data directly from the core banking system, or because RiskRadar is going to consume exactly the same data that the bank is already, or the organization is already analyzing through their transaction monitoring system, the transaction monitoring system can also produce that query that it's uploaded into the data collectors that I talked about. And those are then uploaded by the client directly onto their data vault in RiskRadar, which is in the cloud. And so they're the only ones that have access. That stays, that stays up in the cloud with a key only for the client. But it's not through an API. But it's what I think they call this process. It has a name. It's like a virtual API or something API, but it isn't an API like what we know that when we connect directly with like Zelle, for instance, that it is directly connected to our bank account. But it's an easy process. The beauty of it is that it could be the data can be extracted from different platforms. A lot of banks don't have, for instance, they have legacy systems. And because they have legacy systems, cash is running through one system. The rest of the transactions are running through another one. Wire transfers are running through another one. So by doing the SFTP process, all that data is collected through queries, and then in one shot is uploaded through the data collectors, and then through that SFTP directly to the cloud, to the client's data vault.
Thank you, Maria. Another question here. What other documents can we use in the absence of a national risk assessment for certain countries?
I'm sorry, can you repeat that question again?
Sure. What other documents can we use in the absence of a national risk assessment for certain countries?
Well, the document is the INCSR report. That's what we use a lot here in the United States. I always have to say that the AML index is very good, the Basel AML index, because they analyze a lot of the reports and a lot of the reports that have been issued by the countries. There's also the CIA fact book. It's really good. We use that a lot. But those are the ones that I would say are pretty good. I see that we have a few questions here.
Yeah, that's where I'm pulling them from.
Okay.
On slide 2, Ana Maria, you talked about how the proposed rule would make best practices such as innovation and adoption of technology a regulatory expectation. With regards to technology, what are you seeing in the industry, and how focused do you feel that regulators or auditors are on this application of this rule regarding specifically pertaining to technology?
You know what? I'm seeing that a lot of transaction monitoring systems are starting to adopt AI. And so therefore regulators are really honing in on, if you're using that, you're using new technology, what are you doing to make sure that that technology is actually providing adequate information. So yes, absolutely. The first thing that they're asking is what have you brought in new? Okay. And
Mhm.
what are you using internally to be able to manage risk related to that you brought new? So it's all related to technology in the end. So yes, I do see that there's going to be a lot of they're going to hone in into that area for sure.
Thank you. Can you go to the next slide, slide 3? I had a question on that one. It's also one of the questions from the audience, so I think it'd be good to go to that one next.
Okay, yeah.
Perfect. So you list 8 key steps as a framework for what a sound risk assessment should look like. How would incorporating a quantitative, bottom-up approach not only enhance the process, but also signal to any local regulator as a more robust risk assessment? What makes that bottom-up approach something that we want to focus on instead of that only the top-down qualitative approach?
Okay, well, the bottom-up approach, what it tells the regulator or the auditor is that there's been no intervention that is actually gathering the information directly from the source, and a third party didn't just give it to you. So, in a way, let's say that you ask for the information and the traditional way, you go to the different departments and you ask for information and they give you that information. That already comes to, if the compliance officer is the one that's doing this exercise, that's already going to come through a third venue, which is you ask the head of, say, loans, the loan department, the commercial loan department. What were the total number of loans? What is the outstanding balance? What is your projection for next year? What is the total number of loans that you're going to be booking? Which ones are the ones that are maturing? All of this information, and they answer. How do they answer it? They'll ask someone in IT to provide that information, or they have a query that they've created directly from IT. So IT would be the source. So with a bottom-up approach, by creating already this data collection process, all that information is already extracted directly from the core system onto that data collector, no manual intervention from anyone else, and you're actually getting the data, the exact data. So if I'm a regulator, I know that it didn't come from one department turned over to another department who may have taken the information correctly or maybe even doctored it because they want to look better, and then sent it to you, which is what you're using to produce your risk assessment. So that distance between the source and the final user for the risk assessment is where a lot can happen, and you may not have clean data. So by connecting the process directly from the data collector to the data itself, eliminates those 2 other steps, and it allows for the data to be hopefully cleaner.
Perfect, thank you. We just have time for one more question.
Okay.
I know we're running up against the clock here. Are there any transaction monitoring systems that your platform has already connected to in order to get the data you need?
Yes, the one that we have, and we started very early on, is one that it's Ocean Systems ECS, and the reason why we did it is because we know that a lot of our clients, both here in the United States and abroad, use that system. So we looked at our CSMB's portfolio of clients, and we said, okay, of all of our clients, what are they using? And a significant number of them were using ECS. So we went and we talked to the folks at ECS, and they immediately said, oh, absolutely. This not only is a great idea for us because it allows us to provide our clients with an additional resource, okay? And we don't have to do it. You already have it. So we just do the plugin. And the plugin with them is that they created specific queries so that you will be able to, as a user of ECS, be able to upload directly to your data collectors and SFTP using without having to even talk to IT, because all of that data that you're already pulling into your ECS monitoring system is already going to be used by RiskRater. So it's that's one. We're also working, and I think we finalized the connection with Verafin. We're also working, and that I don't know exactly where we're at with Sentinel. And I
Monitor
don't know.
Plus is another one that we've worked on in the past.
Okay, yeah. Monitor Plus is one that we will. Yeah, we've had a couple clients that that have already worked with that. But I want to say that our chief and pioneer system was ECS by Ocean System. And it works. It worked beautifully. It still needs tweaking because not every bank has exactly the same things. This is the I want to say the drawback of a risk assessment. It's very unique to every bank, so it's very difficult to just get it exactly right all the time. So if you're using ECS and you're using RiskRater, then that upload may be different for you. All you need to do is just ask ECS, can you tweak this for me? And that would be it.
Thank you so much, Ana Maria, for your time, expertise you shared with us today. I trust everyone received some value out of today's webinar. Please feel free to reach out to me or Ana Maria if we have any questions that we were unable to get to. As an added bonus, we'll be hosting a RiskRater workshop next Tuesday at 11 a.m. Eastern Time, where we'll discuss the application, how the application incorporates the best practices Ana Maria reviewed today, and then go into a demonstration of the solution. You'll be receiving an email later today with a recording of today's webinar and a link to sign up for the workshop should you be able to make it. It'll also include my direct email address and Ana Maria's as well, in the event you'd like a personalized demonstration of RiskRater, but unable to attend next Tuesday. Thank you all again for joining.
I have
go ahead.
A quick request. I would love to be able to get all of the questions. I don't know how you guys can do it because I would like to answer them. I see that some of them were written in Spanish and they may have not been addressed, and I would like to be able to address them. So if you guys can send me these questions, I'll be happy to respond to everyone that asked.
We'll have them in the transcript, so we'll get to everybody.
Okay. All right.
Directly.
Well, thank you again, everyone. Thank you for participating, and we look forward to seeing you in our next event. Oh, there's another one in November, right? All right.
Yes, there is.
Okay. See you then. Thank you, guys.
Bye-bye.
Bye-bye.